John, you've talked about inflation about as long as anybody I know. And it started back in '08 when the crash came and interest rates went down. And you back then were advocating, look, we've got to get some inflation here because we need to raise interest rates somewhat. So how does that philosophy play into where we are in 2024?
I think low rates enable cheaper borrowing, which pushes up values. There's no question. And we had really favorable borrowing environments up through 2022. And then we had an unprecedented quick spike in interest rates, which turned that faucet off and turned it on its head. And so now we're in that correction. And I do think we have to be mindful of inflation because everyone pays more for everything with inflation. So tamping down inflation is a good idea. But generally, I've been an advocate of we could have used the Fed funds rate higher over the last decade a bit, keep more dry powder in the Fed's tool chest, if you will. It would have given them probably a little bit more latitude to do things more strongly, more quickly. So I'm an advocate that it's a rare day we should have a Fed funds rate that's near zero. And we had that under one for a decade. And that was probably too long. And now it was really low, very low in 2021 and 2022. That was probably too low. And then they reacted the other way and shot it up. Now everyone's speculating, is it going to stay higher for longer is the latest mantra, or is it going to trickle down but at a slower rate? I think we all agree that we'd like to see a Fed funds rate between 3 and 4, and we'd like to see a stable 10-year treasury around 4% or something like that. That would be great because the markets like stable borrowing rates and some predictability because every investor has a spreadsheet that projects values and income and debt costs. And if you can plug in stable debt costs to remove some of the risk, they can be a little bit more active in the market. So yes, I would say on balance, I would have liked to seen a higher Fed funds rate over the last decade a bit, but that's water under the bridge now. Now, what do we do going forward?
Gentlemen?
Yeah, all I could think about while you're talking about that is how much I've heard that period of low interest rates after '08 equated to a sugar high, and the market got used to it. And what happens after you have the sugar high? You have the opposite, right? And so not necessarily a financial market crash is not what I'm referring to. I'm really referring to the feeling of this is what we got used to. And now that's not going to be the normal anymore. And so the markets, things have to reprice and readjust. And every time things have to turn over like that, change is never comfortable. Not, at least not in my experience, because you have to get out of the current mode that you're in. And that takes some effort and some questioning of your current, thought processes and perspectives. And that's usually not a comfortable situation. That's literally what we are going through in financial markets right now as we speak.
Andrew, let me change the focus just a little bit to one of your true passions, which is financial literacy. So when I was in junior high and high school, financial literacy was the ability to balance a checkbook. I think we've evolved a little bit past there. But I really wanted to use your passion around financial literacy to ask, are you teaching instructing in your educational classes people to really take this long-term view and to look at a variety of investments, have a diversified portfolio to understand that, yes, there are going to be ups and downs, but you stay with the market, you're going to have more ups than downs over the long term. And the long term is 5, 10, 15, 20 years. Is that a message you think is resonating today?
I do. And there's a few reasons for that. Mainly the phrase time in the market is greater than timing the market or trying to time the market. That comes to mind. And I think that getting that message out there is of the utmost importance. And some people might not recognize how important that is. But when I open up the conversation to talk about, this just happened actually over a board meeting I was at during lunch today, where we talk about giving thought to who we take financial advice from, because especially in today's world, we're so connected and we're inundated with information coming to us, usually through social media channels or online or Fox News or whatever it is. Pick your flavor there. But we don't give a lot of thought to who we actually take advice from. And that's a really big deal because it makes it confusing for the consumer, because we hear all this stuff usually perpetuated with some kind of fear behind it. And we don't know whether or not we should listen to that. And the story that I heard this today was this lady saying, my doctor said he was shorting the S&P. And it was confusing for her because she looked at him and was like, oh, he's a doctor. He must be smart. Should I listen to that? And it's those simple concepts that we don't really give a whole lot of thought to. And it starts with the basics. So when we're talking about financial literacy, and I'm trying to put that message out there, we are quite simply talking about the basics. And one of the main fundamentals of long-term investing is compounding and time and how that equation works, right? And so when you pair that piece of knowledge or information with a personal balance sheet and what that is, and here's an asset side and here's your liability side, and it's just what you own and what you owe, and you net the two together and you get your net worth. And I mean, that's as basic as it can get. And you throw compounding in the mix and you show them what investment accounts can do with compounding over time if they live within their means, and the picture starts to become very clear for a lot of those people. And I think that they might come out of, and this, I'm speaking from actual experience, where maybe at the beginning of those conversations, we have a preconceived notion of kind of what personal finance is and what what it looks like to be doing personal finance correctly. But when we come out of the other side of that equation, we start to see how important it is to stick to the fundamentals, just the pure basics, and make sure that we're being conscious of who we are listening to and taking actual financial advice from.
I'd like, you have some thoughts, Gil?
Yes, I'm sorry. I was just going to say, one of the things that Andrew and I do as financial advisors is we're actually educators. We educate people about the world of finance, economics, and we are constantly teaching people about what they need to do to achieve their long-term goals. And so we're always talking to people about balance sheets, net worths, how to calculate those things, why debt avoidance is important, why compounding is important, and how it's your friend. We are educators first and foremost. I know we call ourselves financial advisors, yes, but we are educators at heart, because Andrew and I we have personal life stories that show that, hey, listen, we know what it is to struggle and come from humble backgrounds. It's not fun, it's not easy, and I'm sure that our families would have done things differently if they had the tools and the knowledge and education to do things differently. They didn't. And me and Andrew aren't going to do that to ourselves and our families. So we're going to do everything we can to eat our own cooking and avoid the mistakes that our families made. And it's so sad to hear from people that take advice from the wrong people, from TikTok. That's one of the ones that drives me nuts the most. A lot of my customers get videos sent to them from TikTok, YouTube. Oh, you need to invest in crypto, you need to invest in gold, you need to invest in commercial real estate, cannabis, Tesla, all kinds of stuff. And these are certainly not necessarily things that you would say absolutely not. It's just you really don't want to put all of your money in those things, because that's foolishness. And so Andrew and I, we focus very much on education, and the biggest obstacle to financial education and financial literacy is people's ideas of debt. Debt is generally not a good thing for most people. And we are always challenged, and we always challenge our clients about debt. And so educators is what we do. We're educating people all the time, and we're constantly learning, not only from the things that we do, but from things that we read, and we just try to stay educated on the markets. And so education is a big part of financial literacy for sure.
Michael?
Just a comment and a
Yeah,
quick
grab
follow-up
that.
question. I think the points you make about trusting people and who to trust is compelling. If my social media feeds are indicative of what others see, I'm inundated with messages like that. And sometimes you catch yourself thinking maybe, and then it's like, I have no idea who's on the other end of this. So I thank you for making that point. A follow-up question, and maybe you were going to touch on this later. Gil, you mentioned, given the correction John described, maybe it's an opportune time for individual investors to stick a toe in the commercial real estate. How are you telling people to pursue that?
Certainly, one of the ways you can do it is directly by buying perhaps an interest or a little office building. And when we talk about commercial real estate, John's idea of commercial real estate might be office towers that were built for $20 million and they've got thousands of tenants. But commercial real estate is so much more than that. There's all kinds of different ways you can get into commercial real estate. My idea of commercial real estate is a income producing property that you invest in for rental income, basically, whether that's you're doing it through residential real estate, because in some ways, if you're not living in there, it's a business that you're running when you rent it out. So that's one way to do it. There are certainly little office buildings, strip centers, mini storage units. There's all kinds of things you can get into that generate a cash flow to you as an investor if you wanted to buy into them. Now, a lot of people hesitate to directly buy commercial real estate because of the cost to do it. There's usually financing costs, there's usually title companies, and there's a lot of expense to do those things. And some people try to avoid those. There are other investment vehicles like ETFs, mutual funds that do the same thing, invest in commercial real estate. There's low barriers to entry, and you don't have to do it directly. It's the manager that's doing it directly. So there's some different ways to invest in commercial real estate. And so it really is dependent on you, the investor, how you want to do it, what your thoughts are on being a landlord, because that's in essence what you're doing. Frankly, some people should not be landlords in any way, shape, or form because it stinks sometimes. There's all kinds of things that could happen about being a landlord, but there are other avenues to get into commercial real estate and dip your toes in the water. They're available out there. They're not necessarily obvious, but working with a financial advisor like me and Andrew or any of the other big investment companies out there, there's ways to get into it for sure. And different sectors of the commercial real estate market too. There's office buildings, multifamily, medical, there's
What was the
strip
thing we just heard
centers.
the other day? Beds, sheds, and meds.
Yes,
There are
yes.
residential utility warehouses or business
That's right.
warehouses, and then medical.
That's right. So there's different sectors. So it really just depends, but there's certainly opportunities out there for sure right now.
Gentlemen, we are at the end of our time. So I wanted to thank John, Mike, Bart, Walter, Andrew, and Gil. This has been great. I hope we can continue this conversation.